The following podcast by Fusion Family Wealth, LLC, Fusion, is intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Please see additional important disclosure at the end of this podcast. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.
So recently, the Fed chair, Jerome Powell, warned of high market valuations. The last time this happened was in December of '96 when Alan Greenspan, almost 30 years ago, issued the same warning with his famous phrase, irrational exuberance, as it related to his view of the stock market. What transpired for the next 3 years, from December '96 to 2000, was the stock market increased by about 25% a year with a historic run. And the market, when Greenspan made those comments, the S&P 500 was about 735, and today stands at 6,600. So let's take that as a lesson to tune out Fed chairs whose mandate is low unemployment and low inflation, and they know nothing more than you or I about the future direction of the stock market.
Welcome to the Crazy Wealthy Podcast with your host, Jonathan Blau. Whether you're just starting out or are an experienced investor, join Jonathan as he seeks to illuminate and demystify the complexities of making consistently rational financial decisions under conditions of uncertainty. He'll chat with professionals from the advice world, entrepreneurs, executives, and more to share fresh perspectives on making sound decisions that maximize your wealth. And now, here's your host.
Hello there, and welcome to another episode of Crazy Wealthy Podcast. We're going to be talking today about the recent commentary that came from Jerome Powell, the Federal Reserve Chairman, this week, where he claimed that the stock markets seem to be very highly valued. That harkens back to a time in December of '96, when one of his predecessors, Alan Greenspan, referred to the market as being irrationally exuberant. So let's explore that, and let's see if the current Fed chair's warnings about a high market indicate that investors ought to be considering reducing their exposure to stocks. So some of the things we need to consider. One is, when we hear somebody with authority like the Federal Reserve Chairman say something about the future, he's kind of implying that valuations are high now, meaning they should be lower sometime in the future to get back to normal. And we think that he knows something that we don't because of his authority, his education, his stature, etc. One thing about the future, the defining characteristic about it, is that there are no facts about it. Somebody who's smart and well-educated and smart-sounding doesn't have one more fact about the future than either you or I. So it's important to remember that. The second thing to understand, we call this also the illusion of predictive value, that because you or me or the Federal Reserve Chairman thinks something is going to unfold a certain way, that the actual outcome is likely at all to reflect what he thinks it will be. And I call that the illusion of predictive value, meaning his thought, your thought, mine has zero predictive value. So just keep that in mind as we talk about whether or not his statement indicates that we should be paring down our stock holdings. In a multi-decade investment lifetime, an investor is going to see many recessions, bear markets, terrorist attack type surprises, 1-in-100-year pandemics, things that are unexpected, happen all the time. And so what we need to do is we need to realize all of those things fall into a category that I refer to as the noise. And the signal is earnings. So it's earnings and only earnings that lead to the increase in stock prices. We need to make sure, if we're going to be long-term successful investors, that we never let the noise drown out the signal. So one of the things that we need to understand, and the media has been carping for the last 2 months about new highs, the market's at all-time highs, could be dangerous, etc. So the market is often at new highs. In the 1188-month period since 1926, the market was at an all-time high about a third of the time. 363 of those months were at an all-time high. In just the last 2 years, in 2024, the market hit close to 60 all-time highs. And this year, we hit close to 30 all-time highs. So in just the last 2 years, almost 100 all-time highs. Investors who responded to any of them by taking it as a signal to sell stocks because it somehow might indicate that they're about to go down has been disappointed. And it's been that way throughout all of history. So one of the main lessons behaviorally to take away from this is that neither stock market valuations or anything else have ever been, nor will ever be, able to be used as a consistent market timing tool. It's very important to accept that truth because it is a truth. We're always looking for certainty, and it's a human nature bias that we can't fight, and it's something called hindsight bias. We like to kind of know the past, and knowing the past makes us believe the illusion that somehow, because we know the past, the future will be more predictable. It won't be. So it's important also to let go of that hindsight bias and that constant seeking of certainty. It doesn't exist anywhere in nature, certainty. One of the things I want to talk about is in my lifetime, when I was born in 1967, the S&P was about 500. The S&P 500 index was about 90. Today at 6,600, it stands 73 times higher. There were many, many, many all-time highs since I was born. If I had 10 friends in the room and you could use their fingers and toes to count them, you still wouldn't be able to get to the number of all-time highs in my lifetime. But the S&P went up 73 times. So a million invested then is 73 million. Inflation is up 10 times. To buy what a million bought back then, I would need 10 million. My stocks have given me 73 million. And dividends, my cash flow that I receive as a shareholder in the stock in the S&P 500 have gone up 26 times, more than 2.5 times what inflation went up with the cost of living. But in that time, there were many, many new highs. There were about eight or so bear markets, meaning the market went down 20% or more. There were probably a similar amount, 8 or 9 recessions. And by the way, of the bear markets that I just mentioned, the 8 or 9 that occurred since my birthday, in 1973-4, one of them caused the market to halve. In 2000 to 02, the market halved again. And then in 2008-9, the market halved again. So 3 times in my lifetime, the market went down 50% or more. That's an event that happens traditionally once or twice in 100 years. Through all of that, the return that accomplished a 73-fold increase since I was born in the market level was about 10.5% a year, which coincidentally is the same as the almost 100-year return for the S&P 500 since it's been recorded. So what does one have to do to make 10% a year, or I should say have the high probability of achieving those kinds of returns? What they need to do is they need to buy their portfolio, elect to reinvest in the dividends and not look at it and react to it. And that's all they needed to do. But most investors don't do that. They worry about new highs. They worry about recessions and pandemics and Democrats and Republicans and terrorist attacks and everything else that has nothing to do with where their long-term stock prices are going to land, because there's only one reason that stocks go up in the long run, and that's because earnings relentlessly go up in the long run. So when I was born, the earnings for the S&P were $5 and change. Today, they're $230. Through all of the events I just mentioned, and the bear markets and the recessions, they went from 5. And why do they do that? Because the companies that we buy are relentlessly responding to any kind of challenges rationally. If we're in a recession, they're going to close down capacity. They're going to lay off workers. They're going to pay down debt. They're going to do the opposite of what Western governments do. So the other thing I'll mention is try not to get into the habit, again, of looking for certainty and making predictions or believing predictions. instead of predicting, use the P word, preparedness. Make sure that emotionally you understand what drives us to make these poor decisions, and then financially be prepared by having 2 to 3 years living expenses outside of stocks. That protects you against what's called sequence of return risk. In other words, if you're investing for multi-decades and you're going to make 10% a year likely over the multi-decade period, we don't know what next year will be. It could be down 30 or down 20, just like it was in 2008 and 2009. So to protect against that, and knowing that since 1926, the market from a peak in value where it is today at about 6,600 to a trough, with the average bear market being down 33%, a trough might be about 4,000, and back to new highs, that round trip has taken about 40 months since the 1920s. So as long as we have 2 to 3 years living expenses, we protect against that potential. And one word I'll say on the economy. Many big firms like to roll out their economists and tell you what the economy is about to do. They don't know any more than you know about what the economy is about to do. But one thing I can tell you, I feel comfortable about saying as it relates to the economy, is that based on all of history, it's a good bet that the past is not as good as we remember. The present is not as bad as we think, and the future will likely be better than we anticipate. With that, I wish everybody a happy fall, and thank you for tuning in to this Fix It Friday. Look forward to seeing you next time. You can catch us on all of your favorite podcast venues, as well as the Crazy Wealthy Podcast website and the FusionFamilyWealth.com website.
Thank you for tuning in to another episode of the Crazy Wealthy Podcast. For more insights, resources, and to sign up for our newsletter, visit crazywealthypodcast.com. Until then, stay crazy wealthy.
The previous podcast by Fusion Family Wealth, LLC, Fusion, was intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy, or any non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation. Neither Fusion's investment advisor registration status, nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Fusion is engaged or continues to be engaged to provide investment advisory services. Fusion is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the video content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Fusion is engaged or continues to be engaged to provide investment advisory services. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.